What if I told you that millions of people could be following the exact same retirement advice and still be saving the wrong amount? You've probably heard the rule before. Save 15% of your income. Maybe you've heard 20%. Maybe even 25% if you're trying to retire early. It sounds straightforward. Pick a percentage, automate your savings, and you're on your way. But there's one question hidden inside that advice that almost nobody asks. 15% of what? Your gross income? Or your net income? Those two numbers can be dramatically different. And depending on which one you're using, you could be saving far more or far less than you think. I'm Tom, and today we're going back to one of the most common pieces of financial advice to uncover a detail that's often overlooked. By the end of this video, you'll understand why two people can both claim they're saving 15% of their income while living completely different financial lives. And more importantly, you'll know which number you should actually be using. Let's meet John. John is a fictional example, but his situation is surprisingly common. He's recently become serious about retirement planning. After watching a few finance videos and reading several articles, he keeps seeing the same recommendation over and over again. Save 15% of your income. Simple enough. But when John sits down to calculate his savings target, he immediately runs into a problem. His salary says one number. His bank account says another. Which one is he supposed to use? It's an important question because the answer affects every month of his financial life. Before we solve John's confusion, let's make sure we're talking about the same two numbers. Imagine a simple whiteboard with two boxes. The first box is labeled gross income. The second is labeled net income. Now draw an arrow from the first box to the second. Along that arrow, write things like taxes, Social Security, Medicare, insurance, retirement contributions. Those deductions explain why the second box is always smaller than the first. Gross income is the total amount you earn before anything is taken out. It's your salary, bonuses, commissions, or other employment income before deductions. Net income is what's left after those deductions have been made. In other words, it's the money that actually arrives in your bank account. Here's the easiest way to remember it. Gross income is what you earn. Net income is what you actually get to spend. Gross income measures your earning power. Net income measures your spending power. Now let's return to John's question. Suppose John earns $100,000 a year. By the time taxes and other deductions have been taken out, the amount reaching his bank account is naturally lower. Immediately, another question appears. If someone tells John to save 15%, are they talking about the larger number or the smaller one? Here's the answer. When retirement planners talk about saving 15%, 20%, or another percentage of your income, those benchmarks are traditionally based on gross income. That surprises a lot of people. After all, nobody pays their grocery bill with gross income. Nobody pays the mortgage with gross income. People live on their take-home pay. So why isn't the benchmark based on that instead? That's where the story becomes much more interesting. There are several reasons financial planners have historically used gross income, and the first one is surprisingly practical. Imagine two people earning exactly the same salary. On paper, they look identical. But one is single, the other is married. One may live in a state with no state income tax. The other may live somewhere with significantly higher taxes. One may contribute to different workplace benefits than the other. Even though both started with the same salary, the amount landing in each person's bank account can look very different. If retirement advice were based on take-home pay, each household could end up with a completely different savings target, even though they earn exactly the same income. Using gross income creates one common measuring stick. It gives financial planners a consistent way to compare progress across millions of different households without calculating every person's unique tax situation. That doesn't necessarily make gross income the perfect measurement. It simply makes it the most consistent one. And consistency matters when you're creating guidelines designed to help millions of people rather than one specific household. But that's only the first reason. The second reason explains why two people earning the same salary and even saving the exact same amount can still experience very different financial lives. And once John sees that example, the entire idea of a savings percentage starts to look very different. We left John with an important realization. Retirement planners usually measure savings as a percentage of gross income, not take-home pay. At first, that might seem like nothing more than an accounting detail. But it's much more than that. Because once you understand why gross income became the standard, you'll also understand why so many people accidentally compare themselves to others in ways that don't make sense. Let's go back to our whiteboard. Picture two houses sitting side by side. Above each house, write the same number, 100,000 annual income at first glance. These two households appear identical. They earn the same salary. If someone told both families to save 15% of their income, you might assume they'd be making exactly the same financial sacrifice. But now let's draw two arrows beneath each house. The arrows represent money flowing into each family's bank account. Suddenly, those arrows aren't the same length. Why? Because taxes, payroll deductions, workplace benefits, and retirement contributions aren't identical for everyone. One household may be married. The other may be single. One might contribute more toward employer-sponsored benefits. Another may live in a region with different tax rules. Even though both households started with exactly the same gross income, what actually reaches their bank accounts can be noticeably different. That's why gross income became the common benchmark. It creates one consistent measuring stick before everyone's financial situation begins to diverge. Gross income creates a common starting point. Net income tells your personal financial story. Now, let's look at another reason this distinction matters. Imagine John has decided to contribute to a workplace retirement account. Some retirement accounts allow contributions before income taxes are calculated, while others use money that's already been taxed. You don't need to remember every account type to understand the bigger idea. Here's what matters. In one case, the contribution reduces taxable income before taxes are applied. In the other, taxes are paid first, and the contribution comes afterward. Draw two buckets on the whiteboard. Label one before tax. Label the other after tax. Now pour the same amount of money into both buckets. Even though the contribution amount is identical, the impact on John's monthly cash flow feels different. Why? Because the timing of taxes changes how much take-home pay remains available for everyday spending. That's one reason retirement planners continue using gross income as the benchmark. It allows people using different retirement accounts to compare savings rates using the same starting point. But there's another piece of the puzzle that's often overlooked. Think about retirement planning itself. Most long-term retirement models ask questions like, how much income will you need after you stop working? How much should you save during your career? How much income might need to be replaced in retirement? Notice something those questions have in common. They're built around your earnings over an entire career, not simply what happened to land in your bank account after deductions each month. Using gross income helps keep those long-term calculations consistent. It gives planners one common language for estimating future retirement needs. So does that mean net income isn't important? Not at all. In fact, this is where many people misunderstand the entire conversation. Imagine drawing a bridge between two islands. On one side, write retirement planning. On the other, write everyday living. Gross income belongs on the planning side. Net income belongs on the living side. Both matter. They're simply answering different questions. Gross income helps answer, am I saving enough for the future? Net income answers, can I comfortably live on what's left today? Those are equally important questions. If you focus only on gross income, you might reach an impressive savings target but struggle to pay your monthly bills. If you focus only on net income, your lifestyle may feel comfortable today, but you could discover years later that your retirement savings haven't kept pace with your long-term goals. John finally realizes the mistake wasn't choosing the wrong percentage. The mistake was assuming one measurement could answer every financial question. Gross income and net income aren't competing ideas. They're two different tools. And just like any tool, each works best when used for the right job. In the final part, I will show John a simple three-step framework that combines both measurements into one practical savings system, one that's realistic enough to live with today, while still keeping retirement on track for tomorrow. Now we've reached the most important question. If gross income is the right benchmark for long-term planning, but net income determines what you can actually afford, how do you bring those two ideas together? The answer isn't choosing one over the other. It's understanding that each one has a different job. Let's go back to John. When he first started planning for retirement, he thought he had to pick a single number and build his entire savings strategy around it. Either use his gross income or use his take-home pay. Now he realizes that approach misses the bigger picture. Gross income helps him plan for the future. Net income helps him manage today. Both matter. They simply answer different questions. So here's a simple three-step framework you can use. Step 1. Use gross income to set your long-term target. If your goal is to save 15%, 20%, or another percentage for retirement, calculate that percentage using your gross income. That's the standard used by most retirement planning models, because it creates a consistent benchmark. It helps answer questions like, am I saving enough? Am I making progress? Am I moving toward the retirement I want? Think of gross income as your long-term roadmap. It tells you the direction you're heading. But a roadmap alone doesn't tell you whether the journey is comfortable. That's where the second step comes in. Step 2. Test that goal against your net income. Look at the money that actually reaches your bank account each month. After paying for housing, groceries, transportation, insurance, and everything else life requires, how does that savings goal actually feel? Does it leave enough room for unexpected expenses? Can you maintain it without constantly feeling financial pressure? Or are you sacrificing so much today that the plan becomes impossible to sustain? This is where many people discover the difference between a good financial plan and a realistic one. A plan only works if you can continue following it year after year. That's why your net income deserves just as much attention as your gross income. It tells you whether your savings goal fits your real life. Now for the final step. Step 3. Adjust based on your own circumstances. Personal finance is called personal for a reason. No two households are exactly alike. Imagine two people earning the same salary. One has no debt. The other is paying off student loans. One lives in an area with affordable housing. The other faces much higher living costs. One receives a generous employer retirement match. The other has to save entirely on their own. Should those two people automatically follow the exact same savings percentage? Probably not. Their financial lives are different. And their plans should reflect that reality. The goal isn't to chase a perfect percentage. The goal is to build a savings system you can maintain consistently through changing jobs, changing incomes, and different stages of life. That's exactly what John finally understands. The percentage itself was never the real lesson. Understanding what that percentage represents was. Once he stopped treating gross income and net income as competing ideas, everything became much clearer. Gross income became his benchmark for long-term planning. Net income became his guide for everyday budgeting. Together, they created a savings plan that was both practical and sustainable. And that's the bigger message behind today's discussion. Financial rules are incredibly useful, They simplify complicated decisions. They give us a place to start. But they aren't universal laws. They're guidelines. The best financial plan isn't the one that follows every rule perfectly. It's the one you can stick with consistently for decades. Because long-term wealth isn't built by making one perfect financial decision. It's built by making good decisions over and over again. I'm Tom, and I hope today's discussion helped you see retirement planning from a different perspective. The next time someone tells you to save 15% of your income, you'll know the first question to ask. 15% of what? Once you understand that answer, you'll be able to build a saving strategy that's not only based on sound financial principles, but also designed around your own financial life. Thank you for spending your time with me here on Wealth Tom. If you found this video helpful, consider subscribing for more straightforward insights on retirement planning, investing, and building long-term wealth.